Everyone tells you to invest your money in the stock market, to put that hard-earned money to work so it can make you more money. The problem is how to start. This video is going to be a beginner's guide on how to start investing. Straight to the point, full transparency, no fluff or distractions. I will be going through a step-by-step process that by the end of this video, you should have more than the basic tools to invest in your future and change the course of your life. Let's dive in. Number 1, understanding the reason for investing. In order to start investing, you have to understand the reason why you are investing. You invest for financial freedom because you don't want to work forever or have any worries about money. You invest so your money makes more money and then reinvest that extra money earned to make more money. That is called compound interest. You invest because inflation eats your buying power throughout time and investing reduces that effect. You invest because you want to generate passive income while you do other things in life. You invest because you want a decent retirement. Regardless of your motive, you want to put that money to work early as possible. Reflect for a moment and think why I should be investing. After you figure it out, keep it in mind as a long-term goal. Any reason to invest is valid and always have it present as the ultimate reason to remain consistent. Number 2, now that we have a reason to invest, we need to check our financial health. And by this, I mean that you must be in a position where you are able to set money aside to invest. So how do we check our financial health? In simple terms, money in, money out. How much we earn versus expenses. That simple calculation allows us to see how much money we have left and how much we are able to invest. Every scenario is different. So keep in mind that this is your path. Everyone has different income, expenses, debt, emergency fund, and so on. So it's important to do your own calculation or sit with a financial advisor to find the most optimal way to establish a budget and start investing. Number 3, now that you have your leftover cash ready to go, we need an account where you can invest. Besides having an employer-sponsored account like a 401k, you can choose between an IRA, Roth IRA, or a brokerage account. Let's go through their main differences, starting with purpose. The purpose of an IRA and Roth IRA is that they are retirement accounts with some tax benefits and rules to follow, while a brokerage account is just for general investing with less limitations. Tax benefits. For the IRA, the money you put in is tax deferred, meaning no taxes were taken out of the money invested, and you will pay taxes when you get the contributions or gains out. For the Roth IRA, the money invested has already been taxed. However, it grows tax-free when withdrawing the money. The brokerage account doesn't have any tax benefits. Contribution limits. Both IRA and Roth IRA have contribution limits of $7,000 yearly or $8,000 if you are age 50 or older. Brokerage accounts have no limits. Income limits. Traditional IRA have no income limits while Roth IRA does. This means that if you earn an X amount of money per year, you cannot open a Roth IRA. Brokerage accounts have no income limits. Withdrawals. For the traditional IRA, if you take contributions before 59 and a half, you will be taxed and penalized. For the Roth IRA, you can take your contributions out at any time, but the money you earn inside the account, you can withdraw it after 59 and a half and 5 years of participating in the account. On the other hand, for the brokerage account, you can take the money out at any time, and depending on the transaction, capital gain taxes can apply. And last, the required minimum distribution, or RMD for short. This is the age when you must take out the contributions from the account. For the traditional IRA, it starts at 73 years old. For Roth IRA and brokerage account, there is no RMD. And there you have it, some of the different type of accounts to start your investing journey. Some of the notable names out there, you can check Vanguard, Fidelity, Robinhood, Charles Schwab, and One, and so on. So go check them out and read about their products and rules before opening an account. Number 4, after having your account ready to go, it's time to learn about stocks. Within the investment accounts, there's 2 securities that are often bought, and those securities are ETF and stocks. An ETF, which is short for Exchange Traded Fund, is a group of stocks combined into one. Think about a basket fruit. The different fruits are the stocks, and the basket is the ETF that holds all the fruits. Now, individual stocks are pretty much a part of the business that you are buying. The management purpose is to invest your money to make more money. Both securities are a way to increase your wealth, but they are analyzed in a different way. ETF are easier to analyze than individual stocks. There is a manager behind every ETF doing the balancing and buying and selling stocks for you. In order to know if the ETF is the right fit for your investment journey, you need to understand the following things before investing in them. Objective of the ETF. Some ETF are focused on following index funds, others in commodities, others in certain group of stocks. Find the one with objectives that aligns to your goals. Performance. You want an ETF with a decent performance. What is a decent performance? Something equal or above than the market average. Expense ratio. You must pay an expense ratio when owning an ETF. This is deducted automatically. The lower the expense ratio, the better. In order to learn about other details of an ETF, you need to find the fund sheet or prospectus, which explains all you need to know about the ETF you're investing in. Now, for stocks, it involves looking at both qualitative and quantitative factors to evaluate a company's performance, growth potential, and risk. Investors use different approaches to understand the business they are investing in. So in general, there is no correct way, but there are optimal paths to evaluate a business. So to summarize, you want a business with 1. Competitive advantage, also known as a moat. 2. Companies within a sector and that has a business model that will be successful or maintain success in the future. Number 3, companies with healthy financial statements. Also know that companies report their financials every quarter, so that's a document that you need to constantly look for. Number 4, you want companies with growth potential, growing revenue, growing earnings, growing margins, and growing adjusted free cash flow. And the list goes on. ETF versus stocks, ETF are more stress-free, less analysis needed, and straight to the point. For stocks, on most occasions, you have to constantly be checking them to make sure everything is in order. Now that you have your finances in order, have an investment account, and know the basics of stocks and ETF, it is time to make a simple strategy to start investing. Number 1, set an amount that you want to invest. It can be $20, $50, or $100. Any amount you are willing to invest. Set the recurrence of the deposits. You want the money to be deposited weekly, bi-weekly, or monthly. Up to you. Number 2, dollar cost average. For new investors, this is a great way to start. Buy fractions of the stock or ETF of your preference and do it consistently. Since you can buy fractions, you don't need the full money to buy a whole share. Number 3, have an investing thesis. This allows you to have a general guidance and reminder of your investing plan and what you want to achieve. Number 4, monitor your portfolio. Do rebalances, cut the heavy weight, keep it simple. Stay committed to learning through books, online courses, investor relations sites, or financial news. To finalize, let's do some investing frequently asked questions. Number 1, what is investing? Investing is the process of putting money into assets like stocks, bonds, real estate, or mutual funds with the goal of growing wealth over time. The idea is to generate returns or profits that outpace inflation. Number 2, how much money do I need to start investing? You can start with as little as $1 on some platforms thanks to fractional shares. Many brokers have no minimums for accounts opening, so you can start investing with small amounts regularly to build wealth over time. Number 3, what is risk and how does it affect investing? Risk in investing is the possibility of losing part or all of your investment. Different assets carry different levels of risk, with stocks generally being riskier than bonds. Balancing risk and reward is key to a success investing strategy. Number 4, how often should I check my investments? For the long-term investors, checking your portfolio once every few months or after major market changes is usually sufficient. Avoid obsessing over the daily fluctuations as they can lead to emotional decisions. Number 5, what is dollar cost averaging? Dollar cost averaging is an investment strategy where you invest a fixed amount at irregular intervals regardless of the market conditions. This approach helps reduce the impact of volatility over time. Number 6, how can I reduce risk in my portfolio? Diversify your investments across different asset classes, bonds, stocks, real estate, and sectors, tech, healthcare, finance, consumer staples. Rebalance periodically to maintain your intended level of risk. Number 7, how is investing different from savings? Saving is setting aside money in low-risk accessible account, often for short-term goals. Investing aims for higher returns by putting your money in potential riskier assets, typically for long-term goals. Number 8, can I lose all my money in the stock market? Yes, if a company goes bankrupt or the market experiences significant downturns, you could lose some or all of your investments. However, diversification and long-term holding tend to reduce the risk. Number 9, what's an emergency fund and why it is important before investing? An emergency fund is a 3 to 6 month worth of living expenses set aside in a safe, accessible account. It's important to have an emergency fund before investing, as it prevents you from selling investments at a loss to cover urgent expenses. Number 10, how long should I stay invested? Ideally, at least 5 to 10 years. Long-term investing allows you to ride out market fluctuations and benefit from compounding returns. So that will be it for this video. Hope you enjoyed this investing beginner guide. If you have doubts or questions, please let me know in the comment section below. Invest as early and often as possible. Hit the like, subscribe if you haven't. Thanks for watching, and I'll see you in the next one.